Morning, everybody. It's April 12th. This is the weekly review where we try to look at what happened, what we think is going to happen, how we might try to take advantage of it. So, in the last couple of weeks, as most of you realize, I've been kind of on the sidelines, and the reason for that is, my take on where the markets are right now is that the markets are not doing what they should be doing, and let me try to explain that. When I take these reads and I look at what the market quote unquote should do, and we create that thesis, we're saying to ourselves, okay, given where we are, this is the most likely scenario from what the market is indicating to us. And so when you make that thesis, then you want to see what the market actually does. And as an example of market not doing what it should do, if I come back to the October lows, do the ABC projections, right? We've got projections quite a bit higher. They haven't fulfilled. Now this is on a weekly, and hey, it could just take a while. But if we go to like the dailies, we've had an ABC projection. Well, actually, it was from here. It's been in place now for I don't know how long, right? I mean, it's what, 1st of February. You had that big run up in February, come all the way back down, go back up, come all the way back down, go, almost all the way back up again, and we're coming into earnings now. When it goes this long, I kind of lose track of the fact that this is even back here. So in other words, this never met its projection. And I don't know how many of these I can look at inside that have done the same thing. This one should get us up to here. Now you have a little nested ABCD in here that just completed. But for the most part, most of these projections for the year just simply haven't done what they were supposed to do. And if I go back, and that's true on almost all the indexes, if I go back, the other thing that continues to concern me is that our markets, domestic markets, continue to be pulled higher by the world markets. And it's not a reflection of what we're trying to do or what our markets are trying to do. It's what the world markets are doing. In other words, we're not running on our own news. We're running on the rest of the world's equity expansion, right? And I guess that's okay. It's just that you're driven by external events more so than by internal events. And you know that the internal events are actually tugging against you. Now, they could change. In other words, internally we could get better economic numbers. These earnings could be better than expected, so forth and so on. But if they're not, right, that's a problem. And at some point that problem, that divergence, if you will, between our markets and the world markets gets resolved either to the downside, in other words, we take control, or we get pulled to new highs as a result of the rest of the world. It's just that if you're depending on some external event, then you've got to keep track of that event. In other words, can Asia keep soaring? Can Europe keep soaring? On the expectations that the QE and the central bank largesse elsewhere is going to keep pushing those higher, and maybe it will. I just don't know. What I know is that our market isn't doing nearly as well, and I'm kind of showing you that here as I was talking and drawing this out. Is we had range trades that set up, and they keep getting smaller and smaller, both in terms of the duration, the width of the range, right, as well as in terms of the size of the range, right? So if I look at them over time, they keep getting smaller and smaller, tighter and tighter. The latest one that we're in here, projects potentially a breakout that could double, right? That's the ideal of a range trade, right, is that it could double. Well, if it doubles, okay, so that means, and just take the numbers. So, take the conservative 2045 and the top about 2117. So you got about 55, about 57. Okay, so that could take us up to 2170 or 2165 or something. Okay, that's a decent percentage. That assumes that it will fulfill. Did it fulfill on the last one? In other words, when we broke out of this range, did we get that expansion? No, we went up just a little bit and then we came back into it. When we broke out of this one, did we get that expansion? Well, no, we haven't failed yet. We did come back into it, but we just haven't seen the projections that you would expect to take place actually take place. And that's a concern because for so long, and I'm pulling over the monthly, for so long this has been so strong without any kind of pullback whatsoever. In other words, the last time we had any kind of real serious pullback was way back here, 2011. And since then, it's pretty much been a straight shot. If these are getting tighter and if we really are setting up some sort of a potential roll, we don't want to be, willy-nilly just taking larger positions or not so much just larger, but directional trades, because the thrashing is going to, cost us heavily trying to stay in those trades. And what I really want to point out here is that thrashing, has been taking place on a big, over and over. And the only way you can keep, when you have this kind of thrash, the only way you can keep from losing money is to do what? Is to widen your stops, right? Make them big. Well, what does that do? That increases your risk. In other words, if this market really is rolling, in other words, if it really is going to roll over, you're not going to take those stops until you get way down here, which means you've got a huge risk. That's what right now makes this so difficult. And to finalize the thought, and I'm going to go to the daily first. We've set up now with a swing point high here and here. We've set up with swing point lows here and here. So in other words, this range again, right, has the potential to make a larger move to the top side or to the downside, depending on which way it breaks. And of course, we're crawling back up to the top again, which in a bull market is typically what happens, right? If nothing else is taking place, this thing's going to grind on up and get up and try to make new highs. Okay, so let's assume a breakout to the top side. What is that bias? Well, so far this year, it has bought us failed projections. In other words, it never has made it to where it said it was going or where it should go. That gives you less confidence that that breakout to the top side is actually going to be able to carry. Now, because there's two swing point highs, we should get a decent break. In other words, one that can carry a little ways before it comes back. Okay, so that's okay. If we look back again one more time, this is going to have a breakout on 2 time frames again. And so from that perspective, it should try to carry. What we have seen is those, and this is in individual stocks as well, those multiple time frame breakouts have failed. I mean, just look back at our portfolio. KeyBank, Facebook, not so much Facebook, but certainly KeyBank. Some of the others. I mean, there's been others before. They get their multiple swing point breakouts, and what do? They go up a little bit, and then they come right back, which is not what they should do. And so I can't have a lot of confidence in the upside. So take the opposite. What happens if these earnings really turn out bad and we break to the downside? Well, again, we're breaking 2 swing point lows here. And if we pull up the weekly again, we're going to not have a swing. Well, if we go 2 more bars, we would have a swing point low here. But on the weekly, it's not a multiple break. The multiple break is down here. And you've got 2 swing point lows down at this level on the weekly as well as on the daily. In other words, you got one here, that's this one, and you've got this one back here. So when I think about just from a risk perspective, reward perspective, I can't be too confident in my reward on the breakout to the top side. I can see my risk to the downside in this area being huge if it were to get down there. So what do I want to do? Do I want to, believe in the upside, or do I want to believe in the downside? I don't really want to, take a chance on either one until it becomes more clear what's going to happen. And that's why I've been on the fence and am on the fence, coming into this earnings season. And by being on the fence, what I'm talking about is I'm kind of non-committal. Yeah, I keep trading, or I keep exposure on this direction because that's the direction the market keeps heading. Until that changes, you have to do that. But I can't take a larger position as a result of it. Last week, markets were up, Russell went nowhere because it's at the top and it can't break out. Everything else starts grinding up towards the top. And that's really what happened last week. What's the quick review? Well, the world markets keep surging. The market in the U.S. keeps getting pulled higher as a result of it. The Fed keeps talking about a rate hike, but the market keeps, acting as if it's in the distant future. Earnings, they start this week. They're the catalyst. Really, the earnings are going to be where it's at this week. And something I've talked about before, and I want to just talk about real quickly again. With the GAAP accounting standards, which is what all the companies follow, you have the ability to cook the books and do it legally. And I'm not talking about in a huge way, but there's enough slop in those books that you can make things look better or worse depending on what you want to do. If I'm a chief financial officer and the CEO of a company, what am I going to do? If things are doing well, which they have the last 2 or 3 years, I'm going to keep pulling back some of those returns and not showing them in the current quarter. Why? Well, they're my rainy day sludge fund, right? I'm going to keep that stuff around for when I need them. And usually you can keep a good quarter or two sludge around. So in other words, if earnings are, let's say earnings, just to pick a number, let's say they're 3 cents a share. I'm only going to show 2 when things are good. And I'm going to keep a penny back. Next quarter, if things get bad, which is what happened in October, then I can pull from that fund and I can make my earnings still look okay. Okay, fast forward. Now we go to January this year. Earnings bad again. Economics didn't get any better. The earnings didn't get any better. So what do? They pull from that little sludge fund they've been keeping around and they make the earnings okay again. Fast forward to today. We're in April. Third time now. You probably are going to find it harder as a company, as a CFO, to go in there and make those books hit those earnings. And that's where we are now. I don't know if it's going to happen this quarter or next, but we're getting to the point where the CFOs do not have that rainy day fund sitting at their fingertips. They've used it. So now it comes to the point of like, okay, if I can't hit those earnings expectations, even though we've lowered the bar, what should I do? Well, typically what happens is at some point they say, hey, I can't hit it. I might as well miss it a little bit worse than expected. If I can't make the number, why almost make the number? Just don't even make the number and take those earnings that I would have shown in this quarter and put them in next. And why is that? Well, because I can build up my rainy day fund for the next quarter in case things don't get better. I've already missed this one. And that's the real question this quarter. Is that what we're going to see on a widespread basis with CFO CEOs? Or are they close enough that they can make them one more time and they're going to take a chance that the July earnings will get better? And that's where we're at. And that's the question. And I don't know the answer. And we won't know the answer until these earnings come out. And we start seeing what these companies actually do. What's the positives? The longer term trends, as we just looked at, still good. NASDAQ, NASDAQ hasn't even done. Let's pull up the NASDAQ right quick here. Sorry, let me grab this. The NASDAQ hasn't even done a retest regen on the daily or the weekly on the breakout. So the NASDAQ, pretty strong. Money keeps rotating, right? If you look at say the Russell, for example, why could the Russell not go up this week when everything else did? Well, because it's sitting at a critical point. It's right at the highs. Matter of fact, the Russell tested the Friday high and failed on price and on volume. So the Russell, can't go any higher and won't go any higher unless these earnings really propel this market. And why is it doing that when everything else, like let's say the S&P made a nice big gain this week? Well, because the S&P isn't up there yet. The money keeps rotating. So instead of putting it at something and paying higher prices, right? If I go back to the Russell, this is what you're always looking at. Are they willing to buy up at higher prices than there have been? Are they willing to pay up? No, they're not. They didn't. What did they do? They went back over to something that was quote unquote cheaper and bought it because it's not at higher and higher price yet. And even though it's a positive, it got over this breakdown bar, if you go over to the Russell, it's a negative that it can't get up and over this and keep going. The money is simply rotating around inside, and it just won't, there's not new money coming in. They just don't want to leave, right? And that's what we keep seeing happen. Transports. The transports actually was a positive, and the positive was that you had, the M&A come in right at the right time. It's amazing how it always happens this way, but at this particular bar on the breakdown, the very next day, FedEx tells us they're going to do a merger in Europe, and that shoots FedEx higher. If I pull up FedEx right quick, it shoots FedEx higher, and FedEx holds, and the transports hold. So once again, there's always something, right, that seems to come, right? In a bull market, there's always a reason to be bullish. And something always comes out of the blue that seems to support that, and it happened this week, and transports held. So they broke down for a day, they held, they get their little bounce, they hold on the weekly. So if we pull this, put it on the weekly, they come down, they do the stick save, they hold, and just like we were looking at on the S&Ps, this hasn't been able to break down yet, right? You can't get the multiple breakdown, multiple time frames. So once again, overall, things still look okay. The M&A keeps coming, and a lot of times, this is, people think M&A is great, and I guess it is. You can look at it as to, hey, companies see others as cheap. Well, why we have all this M&A is because companies can't grow their earnings. There's not demand, and the only way they can increase their quote-unquote earnings is to go find a takeover target. They can't grow organically, so they go buy somebody. And that keeps happening over and over, and yeah, it keeps being viewed as good, until it isn't. Technical negatives. Stagnating prices create the opportunity for a larger breakdown. And that's what I was really talking about. When I'll go back over here, let me pull the S&P back up again. If you can't get higher, so here's the S&P on the daily. If you can't get higher, what happens? Well, you start building out the structure to go lower, or potentially to go lower. In other words, the size of the decline doesn't have to be huge to start hitting some key points. And again, the size of the decline on a longer term basis doesn't have to be huge to start taking out some critical points. These are the weekly swing point lows as well as daily. These, of course, are the dailies. So when a market starts to stagnate, when it can't just keep grinding higher and higher and higher, right, the potential for some sort of a rollover becomes higher. And it becomes higher because key points are closer to the current price point. And that's where we're at right now. And that's the huge danger that's out here. It may or may not be realized, but it's there. The positives, it's central bankers, folks. It's the continued intervention in the markets to force economic activity, which to some degree is being forced, but not hugely, but certainly in the way of equity prices. And we're seeing that, new highs in Europe, in Asia, and especially in Asia right now. They're just, crazy highs. Fundamental negatives, economics and earnings keep coming up snake eyes. We don't see improvement there. What are we going to watch for? Earnings. I mean, this week it's all about earnings. Yeah, there's some fundamental news, economic data. There's Fed speakers all over the place. We got them Tuesday through Thursday. There's like 8 of them speaking. I'm so sick of hearing these people, but they keep showing up. So you have to, recognize that they're there. But earnings are going to be the key. If we look, the question is, are they going to buy them or are they going to sell them? Last week I looked at earnings and said, okay, here's about 8 companies. The only ones that were bought were non-discretionary retail. Everything else was sold down. So it's going to be key how earnings are either bought or sold this earnings season. And, if you haven't looked yet, I'll pull this over. This, oops, let me redraw that right quick. Bear with me a second here while I squeeze this in some and pull it up. So grab this. If we look at these earnings, this first quarter earnings watch list, which I've shared, there's a link in here for you. These are the companies that are going to report. And the dates are here. The way they're set up coming into the earnings, whether they're bullish or bearish or sideways. I haven't done this before. I haven't put it in a watch list and shared it with you. But because this earnings season is so critical, I wanted to throw all the major ones in that are coming up this week. And so I'm going to be looking at these this week to see what the reaction is. And if the reaction is going to be more negative than positive, I think that's going to be a big tell. But we'll have to see. I don't know how it's going to pan out. I don't know what those CEOs, CFOs are going to decide. I know that they're going to be struggling to make their numbers. It's just, can they make them good enough that they're willing to, stick with them and actually show them? Or are they going to back off and say, wow, well, we just can't even make them. So let's just make them worse, right? And if it's that, then we're going to have a real problem. Range trade breakouts, I talked about that. The topside projections can't be met. If we do get a breakout, topside or downside, the real thing to be watching there is, can they go make the projections this time? Upside, the topside has failed over and over for, it's like 3 times now. That's typically not what happens when the market is very strong. In other words, if you break out, market's strong, you're going to go hit your projections. And we haven't been doing that, which gives me less and less confidence that we're going to continue higher. Upcoming earnings, all the data's here. There's a lot of data. You got the ECB on Thursday. Other than that, there's nothing big. It's really the Fed speakers again and all the earnings that are coming out. So if I go to the bottom line here, here we are again. We're climbing up towards the top. We're probing the highs again. My personal opinion is that the function, that this is a function of what's happening worldwide in equity prices, not domestically. And we're being, a lot of times I'll sometimes, show you that like Apple's pulling the market up, or a particular sector's pulling the market up and making the market look better than it is. Well, right now the market looks better, and I'm talking about the U.S. equities, look better than they are because of the world markets. Pure and simple. That is what's happening. If those world markets, start to consolidate versus surge, and we did have Germany break out this week on Friday. So Germany joined France. It looks like that's going to try to surge again, and we have Asia definitely surging, with Hong Kong surging like crazy this week, which is a trade, by the way, I should have put on, which I talked about but didn't in the portfolio, which is a big mistake now that we look back. But neither here nor there. It's it is what it is. We missed the trade. But the bottom line is that we look better than we are, and if those earnings don't come out good, we may pull the world back down with us as we try to fall. I'm totally on the fence here. I do not know which way it's going to go. I keep a small footprint here in the portfolio. I have no strong opinion about which way this thing's going to go. I'm not going to short this market, because there's no reason to go against the prevailing trend. At the same time, I'm not going to get any longer into earnings. We're going to see earnings on KeyBank this week, all the rest of them next week or the following. And, the key here is how do earnings, how are the earnings responded to? Are they going to be good? Are they going to be bad? Is the market going to treat them well or worse? And are the projections going to be from the CEOs and CFOs? Are the projections going to be for better things to come, or are they going to talk things down? I suspect they're going to talk them down, and I think there's a real risk that they're going to miss worse than we think. That's going to be the risk. If I'm wrong, if these earnings are bought, then we'll simply look for post-earnings plays, right? We'll go find stocks that are doing well off their earnings, get the first retrace on them, and just buy them. And try to go with the market through individual companies that have already gotten the risk out of the way. If it's the downside, then we're going to probably stop out of some of these, keep our core positions, and simply try to work higher. There's really nothing to look at in terms of charts other than what I've shown you. You had the negative of the Russell this week in that it couldn't break higher. It failed on Friday. You had the positive of the S&Ps. And outside of that, everything else was just, mush. We just kind of ground higher. So this is the week, folks. This is kind of what we've been waiting on. We'll see how it trades this week and make our decisions about what to do in the coming weeks based on how earnings are treated. Good or bad, one way or the other, we'll be able to make a trade off of it. But in the meantime, I've been on the fence 2 weeks waiting. There's no sense in doing anything now other than to give it a chance to tell us where the trades will be and if they're there. And if they are, we'll take them. If not, well, then we probably did the right thing by sitting on the fence. All right, that's it for this week. Thanks a lot. And, if there's a way I can help you, let me know. I will leave it at that. And until next time, take care. Thank you.